Hello and welcome back to The Note. We've had a positive day for world stock markets today, particularly in China, where people are still looking forward to stimulus and the markets are up almost 3%, and here in the US, where we've had a bounce back, I suspect largely driven by M&A news. We've also got a stronger dollar at the moment. Much will depend on the data that we will be getting later this week. For now, I'd like to concentrate on a more long-running theme that has taken a further step in recent weeks, and that is the underperformance of value as a style. Value stocks are stocks that look cheap compared to their earnings or their book value, and it's been academically proved over time that value is a great investment style, that they will eventually outperform. However, this is how the value style has done, as measured by the MSCI World Index compared to the MSCI World itself and compared to the MSCI World Growth Index. This is a rival style where you invest in companies whose earnings are growing even if they don't look particularly cheap. And you can see that basically ever since the crisis of 07-08, value has done horribly. Why might this be? Well, certainly initially after the crash, it was because a lot of banks looked cheap according to their fundamentals, and obviously they did very badly during the crisis. But if we now take a look at this chart, which compares the Russell 3000 value index here in the US with the Russell 3000, the broad index of the US, you can see that there's been a further leg down recently. I suspect that is driven by energy stocks, which again looked pretty cheap at the beginning of this year and then got an awful lot cheaper, all thanks to the sell-off in oil. More broadly, if you look across this whole period, it's extremely unusual to have value underperform for quite so long. And I suspect it may be because this is an odd rally in which there hasn't been all that much growth. If there isn't much growth, then growth becomes the scarce commodity that people will bid up, and that means that growth will outperform value. Certainly Apple will have helped that to happen. Are there any positive things for value investors to take away from this? Well, first of all, many academics claim that the value effect is an anomaly that will eventually be arbitraged away. Plainly, after these last few years, no stocks really can stay cheap for a very long time. Secondly, it looks as though there's a lot of value pent up here waiting for a catalyst. At the point that we get some turn in market sentiment, which is often when you get an economic slowdown or a market turn, value will start looking good once more. For the time being, I appreciate that may not be much consolation.